time to spotlight the Mag 7, your portfolio. We even have an ETF to talk about here. And Brad Klapmeyer is with us, Senior Portfolio Manager, Large Cap Growth Team over at Macquarie Asset Management. Thank you, sir, for being with us today. So today's a tough day because folks are looking and they're saying, oh, yields are at the lowest levels of the year, and Bitcoin, is at the lowest levels and breaks its 3-month low. And they start to feel like it's risk off and they get nervous. Some are coming in and saying, I'm buying the dips, and others are saying, is something turning and terrible happening? What say you?
Yeah, no, hi, Nicole. How are you? I think that's a wonderful starting place. I mean, I like the discretion, right? Like people are starting to think through things. Well, I think what we've seen in our index, which is Russell 1000 growth, is just significant amount of concentration that's gone on. We all know that these Mag 7 names account for 55% of our benchmark. So I think maybe what people are starting to think through is this narrowness of the market isn't the right thing. That the tech giants, the AI giants of today may not be the growth giants of tomorrow. So as a active manager, we love this discretion. I mean, I started my career in the year 2000, so I remember when communication companies, switchers and routers, Yahoo, AOL, those big internet names, those were selected to be the growth giants of the next decade. And that didn't come to fruition, right? Like something else always comes through with these disruptive technologies that looks different than what we thought. So I think it's fine for people to be concerned and thoughtful about this. I think some of these companies are going to become big winners, and some of them are going to go on to maybe have investors rethink their starting positions. So I think it's okay.
Right. So there's a way to do this and not leave out large cap growth names because you can't cut them all out, I guess, right? Or else you might be left behind if there is, in fact, that tech boom or those names that have led the way continue to do so. I mean, where do you stand on the AI outlook overall?
Yeah, I mean, I think we're keeping an open mind about it. I think what we're trying not to do with AI is just myopically focus on it. Just everything in the portfolio has to be AI, AI, AI. I think the market, and we're seeing it, is aggregating up a lot of expectations around a single thematic. And as asset managers, it's not our job to do that. We need to have exposure to lots of different things. And so I think looking out 5 years from today, heck, a week from today, we have to think about, will things look different? And so we talk about, Nicole, we just talk about two things that we really do when we analyze companies. We talk about known unknowns. There are obviously things that we can try to think through, or scenarios analysis. What's the next quarter going to look like? What's the adoption of a new product going to look like? And we can model those. We can ask questions about those. But with AI, I think there are a lot of unknown unknowns, things that we don't even know what to ask about the technology or how to scenario analysis. And I think that what it means for us and what it should mean for most investors is just have an awareness that we don't have all the answers. And with not having all the answers, it comes with risk too, risk and opportunity.
So it's interesting, in the LRGG fund, your focused large growth ETF launched last year. Less than 50% are those big Mag 7 names. More than 50% is a lot of everything else, right? You have financials, consumer discretionary, healthcare, consumer communication services. Tell me a little bit about this fund. Is this maybe a way to battle some volatility or have a more diversified portfolio?
Yeah, no, Nicole, thanks for the question. We're really excited about this. We think it kind of tackles a couple things. Number one is we just think having a concentrated portfolio is the way to invest. So it's a 20 stock portfolio. And as you mentioned, it's diversified, not just investing in those AI thematics, but across all high quality growth names that we can find. So we spend majority of our time just trying to find those best businesses in the world. And what we're trying to give investors is just a very unique view of a concentrated portfolio, meaning like right now, what we're worried about is if you're investing in a passive index or a passive ETF, what you may find is that you are blindly exposed to those names. You may not be aware of the concentration that you're putting in your portfolio by doing that. We think being concentrated is fine. But we think using discretion and letting an active manager select those names, especially across the Mag 7, is probably going to create a lot of value over the next 10 years.
I mean, how do you feel about the market at this point now on a day where we're seeing, as I mentioned, there's new lows for certain things. The VIX, for example, went above 20 for the first time in a long time. You know, it sort of feels like a day where it's a real risk-off day. But how do you feel about the market overall going forward? The S&P, for example, I mean, we're below 6,000. Do you see 6,000? Do you see 6,500?
Yeah, no, thanks, Nicole. I think let me get out my market crystal ball and we'll start this again. So, I mean, I don't have a perfect view of the market outcome, but I can give you my opinion for sure. I mean, a couple of things that we're talking about here is just that we're seeing in the large cap end of the market are number one, significant concentration. You know, it's not necessarily a problem. A lot of these companies have earned their spot. When you're talking about 55, 60% of the names of the benchmark in one name, that just seems unhealthy. The other thing that we're looking at from a market perspective is just the narrowness of the market. In 2024, and the Russell 1000 growth, only 20% of the names outperformed the benchmark. This is versus a historical level that's around 45, 50%. That doesn't seem healthy either. And then the final part that we've been really thinking about is just this whole idea of how stocks are priced. So thinking through valuation. And while valuations have been good, really since quantitative easing started, valuations have gone higher and higher. That good has been pulled forward. We've gotten the benefit in the markets from the valuations. Unless you think that the valuations are going to double from here, it seems unlikely that we'll have that same benefit. So we think it gets trickier, and we think maybe a day like today and the increase in volatility just is expressing that. Now, that doesn't mean it's bad for investing. I think what we find during these volatile periods is that people really hone in on earnings growth, durability of businesses, things that protect these businesses during points of volatility or shaky consumer or shaky enterprise growth. So we really want to focus in on high quality, invest in the best businesses that are critical infrastructure. And we think those will do well no matter what the market looks like over the next 6, 12, 24 months.
I liked where you said sniffing around healthcare, not even necessarily pharma, but animal health, life science names, parts of financial services, non-rates trades, underlying fundamentals, and ICE and SPGI payments companies like Visa and MasterCard. So you're really showing a variety of ideas here, right? Because you said the unknown unknowns like DeepSeek and what happens with AI, but some of these things you can really sink your teeth into, right? Final thoughts here?
Exactly. Yeah, I think what may end up surprising investors is, I mean, we're aggregating AI optimism in hardware names and in certain areas of the market where we can find a tangible investment. But what may be reality is the same companies that dominated for the last 10 years because they have some proprietary data set like Intercontinental Exchange or S&P Global with their rating business. Those may be the companies that can turn AI into gold because they have something that other models won't have as their proprietary data. So we think thinking outside the box, where can you find the potential next AI investment? It goes back to those high quality businesses. That's our thought.
Yeah, Brad, it's great to chat with you today. Thank you so much, Brad Klapmeyer at Macquarie Asset Management. And keep an eye on LRGG, folks. Thank you.